Good morning, everyone. Today, we're going to take a journey into the essentials of accounting principles and practices. Before we dive into the details, I want you to think about this. Every decision a business makes, whether it's hiring new talent, launching a product, or expanding into a new market, relies heavily on one thing: reliable financial information. Now, behind those numbers is a framework, a system that gives meaning, order, and consistency to what might otherwise just look like raw data. That framework is exactly what we'll be focusing on in this presentation. In just a moment, we'll uncover the core principles and practices that serve as the foundation for trust in financial reporting and sound business decision making. But first, let's set the stage for the journey we're about to take together. This slide provides an overview of the essential principles and practices that guide accounting. Understanding fundamental accounting concepts is essential for grasping the principles of financial reporting and analysis. These concepts form the backbone of effective business management and decision making. Some of the accounting principles consist of the accrual principle, the consistency principle, the going concern principle, the conservatism principle, and the materiality principle. The accrual principle ensures financial performance is reflected in the correct period, not just when cash moves. The consistency principle enables us to compare financial information across periods by using the same methods. The going concern principle assumes the business will continue to operate, forming the basis for asset and liability valuation. Next, the principle of prudence or conservatism reminds us to avoid overstating financial health and to recognize potential losses early. The materiality principle ensures we focus on information that truly impacts financial decisions. Finally, these principles are applied in day-to-day practices like bookkeeping, preparing financial statements, auditing, and ensuring compliance with standards and regulations. Now that we've laid the foundation with accounting principles and practices, let's shift our focus to something more practical: the accounting cycle. Think of the accounting cycle as the roadmap every business follows to turn day-to-day financial transactions into meaningful reports. It's a step-by-step process that begins the moment a transaction occurs and ends when financial statements are prepared. By understanding the flow of this cycle, you'll see how raw data gets transformed into the reliable information that managers, investors, and stakeholders use to make important decisions. Here's the cycle in its simplest form. Transaction occurs. A business activity happens, like a purchase or a sale. Record journal entries. The event is documented in the accounting journal. Post to ledger. Entries are transferred to accounts in the general ledger. Trial balance, a check to make sure debits equal credits. Adjusting entries, updates for accruals, deferrals, or corrections. Adjusted trial balance ensures everything is accurate before reporting. Financial statements, preparation of the income statement, balance sheet, and cash flow statement. Closing the books. Temporary accounts are closed to get ready for the next cycle. When you see it this way, the accounting cycle is less about memorizing steps and more about following a natural flow, from recording what happens to checking the accuracy to telling the financial story in the form of reports. Now that we've explored how transactions flow through the accounting cycle, let's turn our attention to the final product of that process: financial statements. Financial statements are essentially the scorecards of a business. They take all the detailed information from the accounting cycle and summarize it into clear reports that anyone can read, from managers and employees to investors and lenders. There are three main financial statements you'll often hear about. The income statement, which shows profitability by reporting revenues and expenses. The balance sheet, which gives a snapshot of a company's assets, liabilities, and equity at a point in time. The cash flow statement, which tracks how money moves in and out of the business. Understanding these reports is important because they provide insights into a company's performance, health, and future potential. Stakeholders rely on them to make decisions, whether it's an investor deciding to buy shares, a bank deciding to grant a loan, or management deciding how to grow the business. In short, financial statements don't just reflect history, they guide the future. As we move deeper into applied accounting practices, two critical areas we must understand are bank reconciliation and payroll. Bank reconciliation is crucial for ensuring accuracy in financial records. It helps identify discrepancies, while payroll management ensures timely and accurate employee compensation. Let's start with bank reconciliation. This process is all about ensuring the company's books match the records held by the bank. Since timing differences, errors, or forgotten transactions can cause records to differ, reconciliation helps catch those discrepancies. It's a safeguard that ensures the cash balance reported in the financial statements is accurate and dependable. Now, turning to payroll, this is often one of the largest and most sensitive expenses for any organization. Payroll isn't just about cutting paychecks. It also involves calculating employee wages, accounting for benefits and deductions, and ensuring compliance with tax regulations. Proper payroll management helps maintain employee trust, avoids costly legal issues, and keeps financial reporting reliable. Together, bank reconciliation and payroll highlight the importance of accuracy and accountability in day-to-day operations. They may seem routine, but they are truly essential to the financial stability and credibility of any business. Up to this point, we've focused on recording, organizing, and reporting financial information, but the next step is where accounting really becomes insightful: analysis. The fundamentals of analysis are all about looking beyond the numbers. Instead of just asking what the numbers are, analysis asks what they mean. This involves identifying patterns, relationships, and trends within financial data to better understand performance and guide decisions. At the most basic level, analysis often includes comparing financial results over time, looking at ratios that measure profitability or liquidity, and evaluating whether the business is growing stronger or showing signs of weakness. By mastering these fundamentals, accountants and decision makers can move from simply keeping track of money to using financial information as a powerful tool for planning, problem solving, and predicting future outcomes. In other words, analysis turns financial statements from static reports into stories of business performance and strategy. When many people hear the word accounting, they picture someone sitting at a desk balancing numbers. But in reality, accounting opens the door to a wide range of career opportunities that go far beyond bookkeeping. Explore diverse opportunities in accounting careers that ranges from auditing to financial analysis, enabling you to find your niche in this dynamic and ever-evolving field. For example, some professionals specialize in public accounting, providing auditing, tax, or consulting services to organizations. Others choose corporate accounting and finance, where they help businesses manage budgets, costs, and strategic planning. There are also roles in government and nonprofit accounting, where the focus is on managing public funds and ensuring accountability. Beyond these, opportunities exist in specialized areas like forensic accounting, where accountants investigate financial fraud, or management accounting, which involves analyzing data to support decision-making and business growth. And of course, with globalization and technology, careers in international accounting, financial analysis, and even data analytics are expanding rapidly. The key takeaway is this: accounting is not just a single path, it's a profession with diverse directions. Whether you're passionate about audits, problem solving, public service, or strategy, there's a place for you in the world of accounting. Thank you so much for joining me on this journey through the fundamentals of accounting. I truly appreciate your time and dedication to learning these essential concepts. Stay tuned for the next exciting course, where we will dive deeper into intermediary accounting. In that series, we'll explore important accounting concepts and standards, including how financial reporting frameworks like GAAP and IFRS guide the preparation and presentation of financial statements. I look forward to continuing this learning adventure with you. Until then, keep practicing and applying what you've learned. See you in the next course.